Hey everybody, welcome to the webinar on how to buy or sell a cannabis business. My name is Vince Sliwoski. I'm one of the lawyers and partners here at Harris Sliwoski. I'm joined by my partner, Griffin Thorne, and by Andy Shelley at Can Experts. And I'll just say personally, I'm a business and real estate transactions lawyer. I've been in the cannabis space almost all my career. So I've been doing deals in the space since I think 2011 or so. And without further ado, I'm going to allow these fine gentlemen to introduce themselves, maybe starting with Andy.
Right on. Hey, I'm Andy Shelley. I'm the CEO and founder of Can Experts, former regulator in Oregon, and we do compliance and licensing for a couple hundred licensees here in the state. We also have a sales side, a mergers and acquisition team for buying and selling businesses.
Griffin.
Hey everyone, I'm Griffin Thorne. I'm one of the partners at Harris Sliwoski. I'm our Los Angeles contingent corporate lawyer. And among many other things, I help people buy and sell businesses. Do a lot of it in the cannabis industry, but a lot in other industries as well. Help buy and sell businesses in California, Washington, Oregon, Florida, all over the place. So happy to be here and talk about some of our experience on the cannabis side.
Great. Okay, without further ado, let's kick it off. We have, it looks like 90 people signed up here. We got a lot of good questions in advance of the webinar, which I appreciate. And I want people to know that you're also welcome to type them in to the chat as we go. And we may get to those here during the webinar too. And we're recording the webinar. So if you miss anything today or you have to step out, if you're not, you can watch this later on YouTube or our website. So without further ado, let's kick it off. First question for Andy, because we don't often have somebody like Andy in these talks. Andy, what's the role, the exact role? Like, what does a broker or a group like Can Experts actually do in a business sale, cannabis business sale?
Yeah, good question. First and foremost, we need to establish some sort of value for what for what's being sold. And that can be, if it's something static like a license or equipment, that's typically done with comps, comparables. If it's a business that's up and running, then we're going to take a look at, profit and loss statements, balance sheets, try to figure out, what something might be worth for that particular industry. And then from there, we are looking for buyers. We're marketing the asset, and once we connect the two people, then we want to try to shepherd these things through as quickly and as possible. A lot of times, those deals will break down with just over time. So you're trying to make sure that everything is happening as easy as possible through the process.
So that's kind of teeing them up for sale and kind of shepherding them through sale. From a buyer side perspective, I guess, Andy, what should these people be looking at in the potential cannabis business acquisition?
From the buyer side, our buyers are getting pretty sophisticated and savvy now. They want to see really clean books. They want to see clean operations. They're looking at employees. Who's coming along with the sale, aging equipment. What are they going to have to put out in the first year to make improvements? They want to know is there property involved? Is there a lease involved? What does that lease look like? Are they able to negotiate a long-term lease that's going to work for their operations? Those type of things.
What do you think from a lawyer's eyes perspective, Griffin? What are you looking for when you see an LOI come across your desk or you're representing a buyer in one of these deals?
I guess the first thing I want to do is figure out whether it's been signed or not. And usually if it hasn't been signed, especially if it hasn't been drafted by a broker or lawyer, I'm going to put a lot of redlining on it. I write about this from time to time. An LOI typically is not a binding document and is really just like sort of an outline of a potential deal. And you can mess them up certainly and make them binding when they weren't intended to, and that's kind of a whole different discussion. If you're interested in that, look at some of my posts on LOIs. But 99% of the time you want them to be non-binding, with the exception of a couple of provisions like confidentiality and exclusivity and stuff like that. So even though they're not binding, I think they're really important because they establish sort of the outline for a deal. And from a buyer's perspective, let's say you set the purchase price at $1 million, and during diligence you find out that there's a $150,000 tax lien that wasn't disclosed. That's something where you'll adjust the purchase price. But a lot of the times, or you'll go back to the seller and say, hey, we're going to adjust the purchase price. A lot of the times in my experience, though, when one side is negotiating something in a deal, the other side is like, hey, this isn't what we put in the LOI. And even though things are like flexible and not binding per se, that's been something powerful I've been able to use, and I've seen other people use going through the process. So I do think it's important to have a good one. On a really small deal, it might not be important, right? If you're just buying, if you're in a state where you can just buy a license and it's like a low value thing, and it might just be better to proceed right to the definitive contract. But in a bigger deal or more complicated one, it's absolutely crucial to get it right. Otherwise, even if it's not binding, there can be headaches down the road.
Yeah, I agree really a lot with that sentiment that even if it's non-binding, it is important to get key terms in there because it sort of sets guidelines, right? I mean, people get expectations in place, and even if it's not binding and not a binding term, when you're drafting definitive agreements, a lot of times, I mean, people are going to draft off the LOI. And when people start negotiating things, you can say, hey, look, this is what we've been talking about. It was written down. I understand we can't force you to do it, but why are you sort of pulling out the rug on a new term now? So I think that's kind of an underrated consideration sometimes in these deals. I also think when you're talking buyers, Griffin, since we're talking about buyers, there's this sort of thinking always that buyers want to buy assets and not stock. Would you agree with that? And if they're buying assets and not stock, do you have to diligence a business as hard?
Well, I mean, the first question is like, where are you actually looking, right? So in California, you can't, I think you effectively can't do asset sales for licensed business just because the license is tied to a business and to a property. States like Oregon have made things much easier for the industry where you can sort of buy the license. I may not be using the right terminology. I'm from California. So that's like the first question, right? Then the second question is, what's better to do, an asset sale or a business sale? And you're right, from a buyer's perspective, it's better to just buy the assets, because when you buy a business, you're buying a business that may or may not have liabilities, and you have to hope that the seller disclosed everything to you. And if they didn't, your ramifications, you're stuck with that liability as the owner of that business, and you're going to have to sue the seller. I mean, there's other things we'll probably talk about later, ways to sort of soften the blow, but at the end of the day, it's much better to just not have to worry about that. Is diligence still important? Of course it is, right? So I think that one of the things you're going to want to look for in diligence is the seller company's financials. The reason being that you want to make sure that even if you're buying the assets, it's a productive business, right? You might be able to get a license in whatever city, but it's still important to know that it's going to be productive. You're going to want to know that the assets themselves aren't subject to an equipment lease or some kind of other document where they're securitized in favor of a third party, and you're just going to get sued 5 seconds later. If your idea is to keep the license housed in the same location, you got to get a copy of the lease to figure out what you're going to deal with, and get in all cases, effectively the consent of the lessor, which can be a huge pain in the ass. And so there's just a lot of things you're going to need to diligence. Of course, it's not nearly as extreme as it's going to be with a business sale. And the sellers will often be more grumbly about it, but you still got to do it if you want to do things the right way.
Yeah. And one thing I would add is that in certain kinds of purchases, like stores, say, especially, even if it's an asset purchase agreement, often the buyer is going to agree to assume some liabilities, right? Because the day they take over that store, vendors are still going to be owed money. And typically, and that's a big reason to diligence things, right? You don't want vendors and other people sort of popping up a month after the sale saying, hey, look at this 90-day-old invoice, you have to pay it. And then they say, oh, I didn't assume that liability. And you just don't want to be in that sort of position or having to go back to the seller for indemnity and things like that. So I think diligence is important, like Griffin is saying, in asset or in stock sales. How about from the seller side, Andy? Like, how should sellers be kind of vetting buyers to some extent, and what should sellers be looking out for when they're approached by somebody wanting to buy their cannabis business?
Oh yeah, absolutely. Yeah, you definitely need to vet buyers. We have, here we have kind of a vetted qualified buyer list, and then we have others that we send out to, um, via email, buyers list. But I mean, you definitely want to see proof of funds. It's gotten crazy how many of these deals have gone down the road for months and months and months, and it turns out they did. Um, and then they should be showing up with their attorneys and have professional documents and these types of things. So we still see, I just saw one last week, kind of a handshake, somebody wanting to do a handshake deal. And I mean, that just turns into a bunch of problems if things aren't spelled out and everybody's represented and that type of more professional transaction.
Cool. I'm seeing a comment from friend of the firm, Dan McKillop. Hey, Dan, how you doing? He's a lawyer out east. He says, particularly for buyers, don't forget environmental due diligence, property purchases, and with respect to the cannabis business's waste disposal history practices. It's critical in environmental strict liability states like New Jersey, where he is. That's true. I've helped buy all kinds of properties with serious environmental considerations attached to them. And if you don't check that stuff out and you just buy it, there's CERCLA and everything else where you could be left holding the bag. So thank you for that point, Dan. Griffin, I didn't mean to interject. Go ahead.
It's fine. I think two other points where it becomes really key to, among other things, diligence a buyer. You have to look at the consideration on a deal, right? So if the consideration is cash, you want to make sure they have proof of funds, or if it's finance, that they have financing. But what about if it's stock, right? If a public company is going to issue stock as part of the purchase price to the sellers, well, I want to know that the company's viable, right? Or if it's an earnout type setting where some of the purchase price is deferred over a couple of years and it's tied to performance of the business.
Yeah.
You want to make sure that they actually are going to staff it to run the way that's going to hit that earnout target. So
a lot of times the stock too is going to be restricted. I mean, it's not liquid like you think a lot of stock is, right? Like you've got to hold it for a half a year or a year until some event happens. So it's not like if you decide you don't want to own that piece of consideration anymore, you can cash it out the day after the sale. Sometimes you're stuck with it and you have no control over it. It's a public company and you can go into the toilet and you're just sitting there kind of sad you agreed to such a big component of your sale price is stock.
Yep.
Somebody's asking, since we're talking about LOIs still a little bit, can we use a generic letter of intent? Griffin, no, right?
I mean, nobody's going to like my answer to this,
Yeah.
but that's my job, is to give answers people don't like. I mean, I wouldn't do it personally. Like if I was buying a business, not that I'm in that position, but if I were, I wouldn't do it because a generic letter of intent can't really capture the deal points that most deals need. I mean, buying a cannabis business is almost never like, I'll give you X dollars and you give me the keys to the business. It's never that simple. It's always very convoluted. You have provisions dealing with all kinds of undisclosed liabilities and things like that. And if that's the case, then a boilerplate LOI is not going to address it. And then at the end of the day, your question might be, can I just simply address it myself? And I usually recommend to people just to have a lawyer look at it quickly and maybe make some edits. I can fix most LOIs up in an hour or two and save people a lot of headaches down the road. And there's some states where you can accidentally walk yourself into a binding LOI. And I kind of alluded to this at the top, but at the end of the day, if you have a binding LOI, it creates a huge amount of headache, especially where the other side suddenly doesn't want to negotiate on a point that's now binding, and you walked yourself into that on accident. I wrote about this a few weeks ago. If you check that post out, it has a lot of information on that point.
Yeah, I think the LOI is a really sort of, like Griffin said, it's not that much work for a lawyer to deal with an LOI, because to us they're sort of standard, right? I mean, they get complex if you're talking about a public company, stock sale and warrants and all the rest, but most of them we can kind of deal with pretty quickly, and that is money well spent. Getting a good LOI in place is money well spent. I mean, there's diminishing returns on other things you might want to use a lawyer to negotiate, but what I really get frustrated by sometimes as a deals lawyer is when somebody brings me a horrible binding LOI and we're stuck with it. And what do you do? I mean, you can try to move around, but sometimes you're pinned. And I think people sometimes say, well, I'll just get the deal ready and then I'll bring it to the lawyer. I don't think so. I think you do a lot better if you bring somebody in who has some perspective on some of these important things on the front end. You'll pay a lot less on the back end. What do you think, Andy? Do you give sort of like general, like, here's what to do thoughts to clients when they sort of come in and they say, I have a potential person on the line? What sort of best practices at that point when a deal seems on the horizon?
Yeah, I mean, definitely to utilize your, everybody that we work with has good attorneys. You know, we share clients between us. So definitely getting them involved. If they're not, you know, using us for part of the deal or any of the deal, then just making sure you have the paperwork in place, good purchase agreements with firm dates, you know, for due diligence, and getting your licensing involved. These are the things that tend to make the deal, you know, go away or get sour at some point down the road. So I love firm dates and a purchase agreement that everybody is sticking to what they're supposed to be doing, and that, you know, and it's just moving along nicely instead of, you know, all these hiccups and delays.
Yeah, lately in the last year or two, we've really been spelling out the dates where everybody has to do everything. I mean, it's not just like buyer has to submit an OLCC application and seller has to submit a change in owner. It's like within 2 days of buyer doing this, seller has to do that, and it kind of goes back and forth. And there's a really well delineated process. And I feel like if you don't do that, people miss it. And I mean, if you do that, people miss it half the time, and you have to nudge them, default them and stuff. But I think it's really important to have that stuff written out in your agreement. Somebody's asked before the webinar, actually, a pretty good question: asset sale versus entity purchase, pros and cons. We've talked a little bit about it. Griffin, could you give like a high level, like who wants an asset purchase and who wants a stock purchase generally in the deal, and why?
If it's allowed under the law, the buyer is going to want an asset purchase. Just like, don't want to assume the liabilities of the seller. And an asset purchase, you know, the liabilities of, let me sort of break this down a little bit. Seller, we'll just call it ABC company, right? It's an entity. It holds a license. It holds machinery. It holds a car and all that stuff. It has loans. It has leases. It has tax liabilities, all that stuff, right? So if I'm a buyer, I don't want to buy ABC company. I want to buy all the individual machines and vehicles and the license, again, subject to law, that I can buy, and then assume only specific liabilities that are relevant to my business, like the lease. Got to assume that, right? You have to have a lease for property. So those various things. So you can be picky and choosy to some extent about the liabilities you assume. If you're buying a business, you can't, because the business just has its liabilities, unless the seller of the business agrees to assume those liabilities as an individual, and like that doesn't usually happen in these kinds of deals. So sellers usually want to sell the business and just, you know, go to Hawaii and sit on the beach somewhere. But the buyer, you know, so that's just where things get negotiated. In my experience, in California, we don't really have asset sales. So it's, you know, the business sale is kind of the default. Whereas in Oregon, where I do a lot of work with Vince, I very rarely see business sales as compared to asset sales, where people are either buying just a license and moving it to a new location, or sticking at the same location, buying the license and buying all of the assets along with it. And then you just negotiate what specific contracts and other liabilities you want to assume. So, I mean, if you're a seller now and you sell all those assets, you suddenly have to deal with winding down the business and all that stuff, right? So it's less ideal, I guess, for the people selling the business, and so they're going to sort of try to get the business there.
I would add to all of that, that from a tax perspective, which is important, the asset sale deal structure is strongly preferred by buyers and strongly not preferred by sellers. And the tax consequences of it are going to depend, obviously, on like the legal structure of your business to begin with. If you're a C corporation, you're subject to two levels of taxation. First at the corporate rate when you receive the proceeds of the sale, and then again at the individual rate when the proceeds of that sale are distributed out to shareholders. If you're an S corporation or an LLC or a partnership, any of these pass-through entities, those entities are taxed. They're not taxed. I mean, you're taxed only once as the gains are passed through to you as the selling owner, but you pay at your individual rate, which is going to be higher than a capital gains rate that would normally be applied to an equity sale. If you're on the buyer side of it, I mean, you don't really care about a seller's tax rate, right? That doesn't matter to you. But you may be strongly motivated by the fact that in an asset sale, everything that you purchase is going to have a valuation as of the date of the acquisition on the closing date. If you hear accountants talk about that, they'll call it a stepped up cost basis or a stepped up basis. And that's a big deal for a buyer. That's a great value when you go to sell the asset. Buyers also receive a restart of depreciation and amortization schedules that comes into play when you're buying things you can depreciate. Real estate's the classic example, but there are other pieces of equipment and things that you can sometimes depreciate. It's another valuable tax break, and neither of those tax features applies for buyers in equity sales. And in an equity sale, like Griffin said, the buyer simply purchasing all of the owner's shares in the business, right, or their stock. And by buying that stock or those shares, they automatically acquire all of the assets and liabilities of the business. It's a cleaner deal from a seller's perspective because unlike in an asset sale, the starting point is that everything's included. It could go on. I guess the last thing I would say that comes to mind is a seller in an equity sale would also benefit from preferential tax treatment. You only have to pay the capital gains rate on the profit. And that's subject to change, right? Congress is always messing around with rates paid on capital gains and ordinary income. Definitions of short versus long-term capital gains are subject to change as well. So stepping back, I tell people, I'll help you do this deal. I can give you big picture thoughts like I just rattled off, but you need to talk with a CPA too and talk with your CPA because there are a lot of considerations around selling, even within the paradigm of I'm locked into an asset or a stock sale. I don't know if anybody has anything to add to that. I've just seen people lose so much money just doing it wrong, like from a structural consideration. And that's sad when that happens. They say, oh, this is how you sell a business. And they just sign something. It doesn't have to be. How about we talk about something a little less wonky and talk about the actual market? We got a bunch of questions, Andy, it looks like. Let me see if I can read some of them. In and around like, how's the market lately? How about this one? Let's answer the question, how overcrowded is the Oregon recreational producer space and how long until attrition normalizes the market? Do you have thoughts on that, Andy?
Yeah, it's crowded. There's no hiding it. I mean, there's a lot of licenses out there. We're currently, at least, we're overproducing. We have a lot of retail stores, so that's driving prices down. A lot of our customers have the same, as for retail, we'll have the same customer count they did 3 years ago when they were making, when they were having $500,000 months. They still have the same customer count now, but they're having $150,000 months, and it's because the prices have tanked so much. They just, those profits aren't there. We have a lot of producer licenses. I didn't think that they would sell, but we have been selling through them like crazy here.
Yeah, me too.
I don't, I thought, oh, these are going to sit here for a while, but we actually keep running out of them. People are, for the most part, buying them and warehousing them a little bit. I mean, we have our compliance officers here and licensing folks have, stuck them in garages and, all sorts of places all over the state of Oregon. We have producer licenses just tucked away in closets, basically. So that one was surprising to me, but they still were selling them pretty quickly, and the prices have been going up.
Yeah, it's interesting. We talked a little bit about that last week. I mean, prices, Oregon producer licenses, a couple of years ago, we were selling them for $250,000. All the way last year, I closed a bunch of sales in the $30,000 to $40,000 range, and I'm sure you
Yep.
did too. Now I'm seeing them listed. What do you guys have them listed at? Like 100, 120, something like that?
Yeah, 100. Our sellers want 120 currently.
Yeah, so it's interesting, and I kudos to sellers, I guess, for holding the line there. I don't think we can attribute all of that to the moratorium that finally passed with House Bill 4121, because I feel like there was a moratorium in place. Essentially, it was just kind of limping along from year to year, and now it's made permanent. But I think it's more of like industry getting together and saying, no, these things have value and they have permanent value, and we shouldn't be fire sailing them.
Yeah.
That's my take on it. I don't know. What about somebody else? Here's kind of an interesting question. Somebody's saying, how do you value licenses? That ties into that. Would you agree, Andy, and maybe Griffin, that producer, like if you're selling a naked producer license, like we just talked about, it's got a sort of arbitrary value with 100,000 or 20,000 or whatever that is right now. If you're selling a store, it's different, right? It's based on sale. Like the naked retailer license really doesn't have an independent value like the naked producer license. Is that how you think about it? That's how I've always thought about it.
That's how, with a license or equipment, like I said, I mean, there's enough comparables out there. You look around, see what other people are selling them for, and that's what they're going to sell for. With retail stores in particular, it takes, I have to dive into the books for a week or more, and I'm looking for anomalies in their operations. But ultimately, I'm trying to come up with a price, because at that point, you're not buying a box or a house.
Sure.
You're buying a stream of income or a stream of debt for the next several years, and then it comes down to whatever our buyers are willing, how long they're willing to wait to get ROI, and we try to land on a price. So
Sure.
everybody's going to be different. Everybody's retail store isn't worth $1 million, but ultimately we will list it for whatever our sellers ask us to. But that's typically after we've had a long talk about what the current local market is willing to invest, and how long they're willing to hold that debt before seeing some sort of profit.
Sure. And then somebody asked a question, which I think I can tie into this. They say, can you provide your thoughts on the likelihood of federal legalization? I guess I'm going to add to that question, Griffin. Can you provide your thoughts on that and what that will mean for buying and selling cannabis businesses and their values?
Okay, sure. So first, just a quick thing. Someone asked when we're talking about naked licenses, that just means buying a license, right? That's not necessarily tied to anything else.
Yes.
As opposed to a business or all the assets of a business or anything like that. You're just buying a license, which, I keep saying this and I always feel like a broken record, but people really need to consider the state law on this, because it might be doable in Oregon. It's certainly not doable in other states. And I've seen plenty of situations where people set deals up that are completely illegal, and that's a whole other can of worms that we'll probably come back to later. Federal legality, I mean, there isn't going to be. You're referring to rescheduling. So, sort of to back up, globally here, cannabis might get moved to Schedule 3 at some point, probably before the election. That really won't make any of these state programs legal in any sense. They're still going to violate the law under Schedule 3. A lot of people have been sort of hand-wringing and thinking that this is somehow a tactic by the DEA to then, or the federal government to then, assert Schedule 3 regulations on cannabis, which I just don't see happening. Like, why would they go through all this effort?
Agree.
To make things better and then make them worse again? I think realistically, things will only get better. And what specifically will get better is that 280E will no longer be an issue. And so right now, if you want to own a cannabis business, you're going to, no matter how good your sales are, you're still going to have pretty thin margins. In a lot of people,
just for if anybody's brand new, what is 280E, Griffin?
Sure. So 280E is a part of the federal tax code that doesn't allow businesses that traffic in Schedule 1 or 2 controlled substances to make standard tax deductions. So cannabis businesses just cannot make the same kind of tax deductions as like an ice cream store could make, or any other business in America. And traffic is the key word. People who sell OxyContin, that's not trafficking, right? The OxyContin Schedule 2, they're not trafficking it in the way that term is defined. It's illegal sales of it, and federally speaking, this is all illegal. So if cannabis is put on Schedule 3, that means 280E just by its text doesn't apply. Of course, it's possible the DEA could move it to Schedule 2, and in which case, not a whole lot would change from this perspective. But that's the big thing. And so will that affect M&A immediately? I don't know, but what I think it'll do is it'll bring capital back into the industry. Back when I started in this space was 2018. Everybody wanted to buy. It seemed like everybody just wanted to buy into a cannabis business or just throw money at the industry. Everyone thought it was just going to be like printing money, and that didn't turn out to be the case in almost all cases. But once that huge impediment to profitability goes away, I think there's going to be an incentive to invest, and probably that's going to drag into businesses wanting to expand. So you'll see a place that has 3 retail facilities want to go up to 5, or want to bring in manufacturing capabilities or whatever it might be. So it'll probably be indirect and take a few months, but I think there'll be sort of a rejuvenation of the industry, so to speak. And at the end of the day, it just sort of remains to be seen as to when that's going to happen. And there's a lot of reporting as to it's going to be next week. I know a guy who knows a guy whose sister is friends with the senator. And, some of that stuff, and it's just I don't know. If ever things change and the federal government completely decriminalizes it federally or regulates it federally and allows for interstate commerce, I mean that's a completely different story. But that's not really on the table right now. Our Congress is completely inept, and there's just no way they're going to do that. I've been saying that for 6 years, and I've been right every year. So, rescheduling will be big, but I think it'll take a few months at least to filter into this specific type of stuff.
I think we will see a boost to M&A, like you mentioned, and like you've said. I've said it for the last 6 years as well. I don't have the crystal ball, but it seems with this being an election year, we might and probably will see something in rescheduling. But as soon as that happens, I think we're going to see a lot of new money. We're going to see banks loosened up for lending. I just think for the last 3 years, it's been very much a buyer's market. Prices have tanked. We're seeing multipliers of 1x, 2x, where back in 16, you might have seen 10x. And so with all that rejuvenation happening, I think we'll switch from being a buyer's market to a seller's market and see a lot bigger, better deals happening. So if you want to buy something, now's probably the time.
There you go. Here's hoping. Okay, let's buzz through a couple of recent questions we got that are all good. We already talked a little bit about valuing production licenses, Andy, but Mark Kramer is asking if there are revenue or sales in play. In other words, it's not a naked license. Does that factor at all in the valuation? If they're selling a going concern, I guess, not just a license.
Yes. I mean, again, equipment, vendor or customer list, those types of things can have value. You have to look at everything. I don't know if you're talking about land, real estate, those types of things should factor in. I think a lot of people, and this is kind of a little off topic, but I think a lot of things that I've seen over the last several years is people really become in love with their brand, and they think they're going to sell their brand for a lot of money. And typically I would tell you that it's probably, that's not something that's, unless you're a really well-known brand, it's probably not going to factor into prices. But having, good lease, having real estate, having something that's up and running, great equipment that, it isn't going to cost a lot, then that can all value into come to a different valuation, I guess, or a better valuation.
Yeah, and even if your brand really isn't affecting like the overall top line sale price, you can still allocate some of the sale price to it, and there may be tax reasons to do that. So that's something to cover with your CPA. I think another question related, Selena Dwyer has asked, do buyers seem more interested in naked licenses or a license and real estate deal combined? I guess what I would say about that, I wonder if Andy agrees, is they're just more buyers for the naked licenses because they're cheaper, right? And a lot of people want a license and already have their own real estate. It's hard to sell. I mean, real estate is expensive typically, and we closed a property last month over $1 million down in Southern Oregon on it. Almost all of them are seller carries at this point, but I feel like those are a lot less frequent, a buyer like that, than somebody who's got, say, 100,000, 120,000 for a license. Would you agree with that, Andy?
Yeah, I see the just the naked license. Those sell pretty quickly, and then you have these ranges where, like, up to $500,000 that you have a full build out and somebody can assume the lease. Those are fairly attractive too and sell quickly. And then you get up into the 1.5 and above. Those are really hard to sell right now. People just aren't seeing the value in it. So if you that's kind of where we're seeing a drop off in buyers currently.
Brad Eversole has asked. Oh, go ahead, Griffin.
Yeah, just to add to that a quick point. I mean, I would say, I can't put a number on it, but a vast majority of cannabis businesses don't actually own the real estate that they're using.
I agree.
And I think the reason for that is that it's much more expensive to buy in the short term to buy real estate than it is to lease it. Lease rates are very high in the industry, but buying a multi-million-dollar property is just not in the cards for most people when they're in a startup mode. And like all cannabis businesses to some extent are startups. So most of them just don't own real estate. So when we're talking about naked license versus asset sale or business sale, usually it's going to be a business that has a lease, and then that means you have to deal with the landlord and get their consent, which it can be a real pain because they don't like to just negotiate with a new person. They just leased it to somebody, and I don't want to deal with this new guy. I've had a lot of headaches over the years dealing with that, but
at the least, you may have to stay on as a guarantor seller.
That's where it gets hectic, right?
You can't just get out.
Yeah. The landlord might say, "Hey, I'll consent to the change of ownership, but I'm not going to release the original guarantor." And then the seller's like, "Well, I don't want to speak a guarantor for someone else's lease obligation," and you get all these funky situations that arise out of that.
Yeah.
I did recently help someone sell a business that owned its own real estate, and what that meant was that the valuation was just much better, right, for the seller, because that real estate's like the best asset a cannabis business can own, essentially, and so very often you see these very low, all things considered, low prices for a business just because they don't have any owned assets. A lot of cannabis businesses, they might have a fancy location, but it's just leased, and they might not own a lot of equipment or anything like that. So every deal is different, I guess, is my take on it.
Yep.
Agree. Brad is asking, what are the average attorney and or broker fees for selling a naked producer license in Oregon? That's a very specific question. I'll answer the attorney part, and you can answer the broker part, Andy. The attorney part is classic lawyer answer that nobody likes. It depends, but they tend to be pretty cheap. And the reason why is, I have a brilliant form that I've adapted over the years, which is 5 pages. So if somebody comes to me saying, I want to sell a naked producer license and here are the terms, that is literally going to take me an hour to get that form ready to roll. And then the question is just how much, if at all, do people negotiate? If people don't negotiate much at all and everybody says, yeah, that looks good because it is a great form, and they don't have all sorts of changes or feet dragging and stuff, that sale is going to come in well under $5,000. I'll just tell you that. If there's negotiation, if people hem and haw, if people sign a contract and then don't perform, it can cost more. So, I mean, it's kind of as you go, but typically I would say they come in at that $5,000 range or so if people are acting responsibly and just kind of wanting to do a deal. What about you, Andy?
We ask for a 6% broker fee. It is negotiable. And again, it kind of depends on whether it's a single license or whether it's a fully operational retail store, it seems like on our end the same amount of work is involved. However, I mean, we do try to, for buyers that are coming in, we want to do their paperwork because we do it faster and better. And there's things that we try to incentivize them with that can bring down the broker fee, and it's just part of our the services that we've been doing for the last 7-8 years. So
got you. Okay, good answer. Let's get back to, we got a lot of questions that came in before the webinar. I want to make sure I get to some of them. One is, I'll ask you this, Griffin. What is, in a sale transaction, what is the purpose of using an escrow, and what's the benefit of using an escrow? Do you need to use an escrow? Tell us about escrows.
No, I mean, you don't need to use one, and I've done plenty of deals without them, but it just depends on how the deal is structured. When you're buying property, I mean, use an escrow, but when you're buying a business or a license, if you're just giving cash in exchange for a license at closing, it's sometimes not necessary, but a lot of the times it is necessary if there's more complicated things than that. One thing people do, we talked about this a little bit, one of the problems that can come up in a deal is there's undisclosed liabilities, right? So if I'm buying, a business in Santa Monica, and the seller says there's no taxes, and then I find out 3 months later after it's closed that there are, hundreds of thousands of dollars in unpaid taxes, in spite of the diligence I did, well, I want to turn around and sue that seller. But you have to just assume that person is gone, or the money is gone, or both. And so
that's why we do a holdback sometimes in our deals.
That's what I'm talking about. Yeah.
Okay.
So this is the thing, it's called a holdback, right? So if I'm a buyer, I say I have to factor, especially in a business sale, I have to factor that possibility in, and the possibility that the seller is just going to split. And what I want to do is keep some percentage of the purchase price held back in an escrow account for some period of time after the closing, let's say a year or two. And that way I can, if there's an issue, take money out of it, right? I can say, if there's $1 million purchase price, I'll leave, let's say 15% in an escrow account for a year or two. And in those first 2 years, if I discover something that's, $100,000, I'll take back $100,000 out of that account, right? And so that's one of the huge values of having an escrow agent. Another way people do it is this, if it's a seller finance at all, meaning, let's say go back to $1 million purchase price and buyer only has $850 on signing or closing to close it, the seller will take a promissory note and is entitled to $150,000 over a payout period with interest, right? And you can offset any liabilities against the promissory note as a buyer, right? So those are two of the common ways to deal with post-closing liabilities. Obviously, if you're buying an all-cash deal, you're kind of those are not options, right? But from a buyer's perspective, that's one of the really good reasons to use escrow. Another reason to use escrow, and this might benefit both parties, is that sometimes at closing, the proceeds of the purchase price are not just going to be given to the seller, but they're going to use to be paid off targeted liabilities. Mm-hmm. And you, as a buyer, I don't want to trust that the seller is going to do that itself, right? So if I'm buying, ABC company, and it has $100,000 in tax liabilities on $1 million purchase, and my deal with the seller is, hey, you pay those at closing, I'm not going to give the seller that $100,000 to go pay the tax authority. I don't trust them. No offense to the seller out there. I put it in an escrow account. I say to the escrow account, here's the instructions for payment of, the IRS or whatever it might be, state tax authority. And at closing, they disperse the money, the $900,000 to the seller and the $100,000 to the IRS. And oftentimes it's much more complicated. There's 9 or 10 people to pay. So an experienced escrow company can manage all that without having to trust that the seller is going to do it themselves. The worst possible situation would be that you pay the $1 million to the seller. He says, oh yeah, I'm going to go pay, the $200,000 in liabilities, and then splits. And then you can't get the $200,000 back, and your business is stuck with those liabilities. You shot yourself in the foot. So I don't know, an escrow agent's going to cost a couple $1,000. It's usually split between the two parties, 50-50. Yeah. And I think it's like an insurance policy, right? It's an extremely good investment. I forget the last deal we did, it was maybe $2,000 for the escrow agent. It split 50-50, and it's like nothing compared to the risks of not having it done that way, So again, I recommend it where possible. Obviously, if you're talking about a $20,000 license being sold, maybe that's not worth it. But
Right.
the average deal, $500K, $2 million deal, yeah, get an escrow agent.
That's a great summary. The only thing I would add to that is there are escrows, and then sometimes people use collection escrows on deals too. Griffin talked about seller financing. That's where the seller is the bank essentially after the deal, and they're paid out slowly over time. That's very common in cannabis deals because of the lack of traditional lending for the most part. And if you set up a collection escrow, that may or may not be the same escrow who kind of did the deal for you. The collection escrow will receive payments, monthly payments, usually under a promissory note or something down the line, maybe for years and years, and then pass those payments on to the seller. It helps avoid disagreements a lot of the time about interest and principal balances. And it also makes it such that the buyer and seller don't necessarily have to have sort of direct transactional relationships anymore. You as the seller don't have to deal with like arranging payments from the buyer and things like that, which can be a pretty valuable insulating services. So that's what I got. I like using escrows, except when it doesn't make economic sense to do so.
Vince,
Right.
should the parties use one of the buyer or seller's lawyers as an escrow agent?
Hell no. I mean, I don't like it at all. It's allowed in some states and not in others. A lot of lawyers don't even have insurance policies that cover that. Don't even realize they don't have insurance policies that cover that. But think about what an escrow is. An escrow is a neutral, right? It's a third party that sits between two parties to take instructions, joint instructions from the two parties to do something. If the escrow is also somebody's lawyer, and under the ethics rules, they have to, zealously advocate for that person. They're wearing two hats, and it gets awfully awkward. And there are ways to do it in some states, and you need waivers typically, and obviously you got to disclose all that sort of stuff. But I just don't like to do it. I just, I wouldn't touch it. Some lawyers will. Think carefully about it if you're in one of these deals and somebody says, my lawyer is the escrow agent.
Yeah, agreed. It's not worth the $2,000. I think that's typically what the people that we use, that's what we're paying as well.
Yeah, same. And at this point, those escrows, they're like the lawyers and everybody else. They've done so many deals that it's not like we have to sit there and negotiate an escrow agreement, or it's not like a lot of extra time. It's not like anybody's reinventing the wheel. This is done in certain customary ways, and it's done and done and done over and over again. So it's kind of a go with which, I want to get my deal done. I want to be serious, and I want to have a sort of insurance, like Griffin said.
Yep.
All right, let's talk a little bit. Here's some other questions we got earlier. How about diligence? We talked a little bit about that already, Griffin. How about this? How is diligence typically handled in a cannabis deal? Who does it? And, how much time is there afforded to diligence? Does it happen before people sign an agreement? Does it happen after signing an agreement? Tell us what you think about diligence.
I mean, more often than not, that's the LOI is going to talk about diligence, and it's going to set a period, let's say 45 days or 90 days or something, 30 days
Sure.
might be fast. And that'll start usually when the parties sign the LOI, and will continue until the period runs out. In a more complicated deal, the purchase agreement might get signed after the diligence period expires, but that's just because of negotiation. Sometimes it gets signed while the period's still ongoing. I don't tend to see like uncapped diligence periods anymore, because people just sellers want to be ensured that the buyer's locked into the deal at some point.
Yeah.
And the way it usually works is the seller, we talked a little bit about when it's important for a buyer to do diligence, but the seller is usually the one. I'm sorry. We talked about when it's important for a seller to diligence the buyer, but usually even in those deals, that diligence is going the other way. So it's initiated by the buyer sending requests to the seller. Like, we have a pretty good diligence form. I have a couple. One is a lot more robust, which is used on bigger deals, and one's more concise. So we'd send that out. It'll include questions about, everything: litigation, indebtedness, financials, tax stuff, real estate issues, licensing, compliance, employment matters. Sometimes you want to even ask for things like data privacy law compliance. And so it becomes even more important when you're buying the business. And then, going through the process, the seller will start to give you documents. More sophisticated sellers will create what's called a data room online. Think of it like a Dropbox where they put things in specific boxes and folders and say, hey, here's your response to question, 13.2. And, you'll have everything organized. Some deals, it's, a lot more informal. And, even though I'm asking people to send us tax returns, I'm not, qualified to read and advise competently on like tax ramifications or financials. So we'll request everything and then we'll send it along to the buyers, CPAs or other financial advisors. In some cases, there may be other really specific professionals that need to get involved to analyze something, like, if there's an environmental issue that involves some kind of remediation, there's a construction issue that might be required, someone might want to bring it to a contractor. There just might be various issues, but most of the diligence process can be run through a law firm. We'll look at corporate governance practices, we'll look at litigation, we'll look at security interests, all that jazz, and tell you what's wrong with the business, and here are the risks, and here are the liabilities, and here's where you should probably consider negotiating because, hey, they didn't tell you about those taxes before you sign the LOI. You might want to try to work on the purchase price a little bit, and things like that. So that's where, besides just like negotiating the purchase agreement, which can take a lot of legal time, diligence can be extremely complicated as well, especially on really big deals, and especially if you have more than one location at play.
Agree. Yeah, rather than add on that, I'm going to just skip ahead because in the interest of time, we're coming up on 8 minutes left and we have other good questions and topics to cover. One is a big picture one that I think people will be interested in. Andy, what are some just key areas that you see deals fail? Like what are the reasons that, over and over, sometimes you'll see a sale fall through? And Griffin, you can answer that too when he's done.
Yeah, I think we touched on it, but definitely hidden. We've seen tax liabilities pop up that weren't immediately disclosed or found in due diligence. Expenses, owing vendors, just things like this that weren't disclosed during some sort of the vetting process. So. Enormous leases that were signed back in 2016 or 15, when the industry was going to be, everybody was going to be billionaires. And so, it's these types of things that you have to deal with. But I mean, after doing, I don't know, 100 of these in the last couple of years, it's kind of, we're getting better at our vetting processes and learning to work through them as well. So.
How about you, Griffin? Do you see any like particular pain points or just things that are kind of hallmarks of a deal that might fail or reasons a deal frequently fails?
I mean, deals will often fail where they're overly complicated, and this isn't just unique to M&A. I mean,
Yeah.
It's just like sort of an endemic problem to the industry where people have these massively overcomplicated deals and things just fall apart, at some point in the process. Obviously, undisclosed liabilities is huge. And people 4 or 5 years ago would still be like, well, I need to buy this business sort of regardless of the situation. People have woken up to the idea that it's not really smart in most cases nowadays. Unless you take the financial hit. And so people are a lot more conservative about it. I've seen deals fall apart from just changes in economic conditions, especially closer to COVID, where, it takes a long time and then something happens in the intervening months where it's like, all right, well, we're not going to do it. And I've seen deals fall apart just because of like one side's lawyer was too, I'm trying to be diplomatic here, but aggressive. Let's just stick with aggressive, right? Where a lawyer was getting involved in negotiating business terms and making things difficult. And one of the parties just said, hey, we'll look elsewhere. So I think they can fall apart for a lot of reasons, but obviously the undisclosed liabilities is always a huge issue, which is just, again, it shows why diligence is so key.
I just thought of one of the odd ones we had, and it was a retail store for sale. Two times, two buyers were ready to buy, and the deal fell through because of their Google, comments from customers. I mean, it was so bad
Yeah.
that they didn't think that they could overcome that hurdle, or it would take them, a year or two. So we had 2 buyers walk away. So
Oof.
that's kind of an odd one.
It's hard to sell a crappy business, I guess.
Yeah.
That's what that comes down to. Well, what about when they do sell and after they close? What do the parties have to think about after closing? Griffin, I'll give you that one too to start.
What do you mean exactly?
Well, I mean, you sell the business, the money comes out of escrow and you're done. Are there any like post-closing considerations? In my mind, a big one is often like allocation of the purchase price, what people report to the IRS about the sale. Sometimes there's license cleanup stuff still that's associated. Can you think of anything else that happens once a deal closes?
Well, I mean, this is where it's important to look at the purchase agreement because you'll want to negotiate post-closing obligations. Some sellers are very difficult to work with, and as soon as the deal closes, they just want to be done with it and that's it. I sold the business. What do I have to hang around for? So, that's not the case always, but it's important to really sort of figure out at the outset what you need the seller for after closing so that you can obligate them to do it. And it's a post-closing covenant. And if they don't do it, then you have, whatever, you have remedies against them. Things that I've seen come up a lot are just sort of mundane, right? So getting the employees rehired if you're doing an asset sale, getting transferred over and assigned in filings with the appropriate state, usually state agency, sometimes the USPTO, and things like that. I've also seen cases where we've had funds or just big investors buy a business and they don't necessarily have any experience in the industry. It's more of an investment, and for those people, it's really important to get the right folks in there to manage the business immediately, right? And if that's where earnouts can become important, where there's structure a deal so that the sellers have to actually be employees or officers or something for some period post closing. And then, of course, like the big one is regulatory stuff. In California, for reasons that I still don't understand, you don't give notice to the state regulators until the deal is actually closed, which is very stupid because then you have, and this is not the way the rules are written, you then don't know if they're going to approve it or not until the deal is actually closed. So that makes things very difficult. And but it's another post-closing obligation. So I mean, there's a lot of different things, but the things that tend to be the biggest snags are these little minute, sort of like annoying regulatory things or annoying IP things that people put off or they just physically couldn't do pre-closing.
The other thing I'd add is that it's the rare sale agreement that doesn't have some covenants or representations of the seller that don't survive post-closing. I mean, if you're talking about a naked license sale, that's it. The seller sells and walks away almost always. But anything else, I mean, there's usually a year or two there where the seller's kind of on the hook for something they did or said leading up to the sale. And I tell buyers, calendar that stuff, remember that stuff, because you might be claim barred and those windows may be shorter than the applicable statute of limitations in your state, right? So like maybe you might have 2 years to bring a claim under common law, but you've agreed to limit that window to 6 months or a year. And if you're a day late and it's a big deal, you're SOL. So that's just something to think about after a deal closes, particularly on the buyer side. Anything to add, Andy? See any weird things pop up after sales close?
We've seen a few like employment agreements to keep the seller around for a few months. I mean, those things are always nice if you're new to the business or you need some time to kind of acclimate yourself to the business. Then that's something to think about in these deals as well.
Got it. Okay, I see a couple of questions which I'm not going to answer about allocations of purchase price with respect to 280E and deductibility of amortization and things like. There's a couple of questions like that. Guys, get a CPA in the sale and talk to a CPA. I mean, we're business lawyers. We understand tax pretty well, but we're not going to be signing your tax returns, or we don't want to touch allocating your purchase price or opine on how you should do that under 280E. So that's how I'd answer that question. I'm sorry I can't give you direct advice on that. And with that, I think we have to wrap up. We are at the hour. I want to thank one of my favorite lawyers ever, my partner Griffin Thorne, and one of my favorite industry entrepreneurs ever, Andy Shelley of CanExperts. It was a great talk. Like I said, It's going to be up on YouTube. It's going to be up on our website. Maybe Andy can figure out a way to distribute it too. Stay tuned to our Canada blog. We publish at least a couple times a week on these types of issues. And best of luck to everybody. It's an interesting time out there in the industry. We wish you the best.
Yeah.
Take
Thanks,
care.
Thank you.